again, to everyone joining us in the room. It's good to have you with us. This final session, at least for the Dubai chapter of the Global Credit Conference 2022. Here, this conversation will focus on funding liquidity. The question is the tide turning for bank issuances? Once more, let me remind you that you in the room can use the iPads you've been provided with to send your questions to me, and I can put them to our panel concurrently in the discussion. Don't wait for the end. And the same for our online audiences. We know there are lots of you all over the world who may have pressing questions that you want to put to the panel. Please don't hesitate to send them in and I'll weave them into the conversation. So here we are. It's the last panel of the day, as I said, and they say that you save the best till last, so no pressure, gents, but we are expecting you to deliver because there are lots of questions around this subject. We're living in a world that's fraught with challenges. Keeping money on the move is paramount to a functioning, fluid financial system. So we're going to ask and perhaps dig deep on how regional banks can drive balance sheet growth, as well as fund and raise new capital, perhaps some of the challenges around that, and perhaps some of you have some real-time stories that you can share. And when growth is slow and inflation is higher, what happens when those taps of cash are squeezed? How do you respond? What are the implications and the follow-through? So sharing our thoughts on this subject, I have a great panel here with me. We have, to my left, Usman Ahmed, who is Head of Fixed Income FIM Partners. So Usman, very nice to meet you. How are you doing?
Very well. Thank you so much. Thank you for having me here today.
Right. Well, I'm very excited from hearing about everything you have to share later in the conversation. And then to your left, we have Patrick Clerkin, Senior Managing Director, Group Funding and Investor Relations at Emirates NBD. And I was just catching up with you before we got on stage. You've been here 15 years in Dubai.
15 years, yeah. Although my grey hair makes me look a wee bit older.
I'm not saying anything. But I think we can draw on a lot of your experience, your regional experience, and hear a lot of stories that I'm sure you have to share with a bit of sort of before and after the pandemic kind of thing. We also have joining us down the line, Gaurang Hemani, who is Chief Financial Officer, Qatar Islamic Bank. And I believe you're joining us from Doha, is that right?
Yes, Manisha, how are you doing?
I'm doing great, and I hope the visibility in Doha is a little bit better than it's been in Dubai for the past couple of days. I've just come to Dubai for the first time in a long time, and I can't see any of the view. But hopefully your weather is a lot better than what we're having here. It's good to see you.
The storm passed yesterday. We passed it on to you guys today.
Oh, well, I don't know if we want to pick up that baton. And last but by no means least, Ali Ahmed, who has been so instrumental in helping bring this panel together, Head of Capital Markets, FIG, AME, Standard Chartered. Ali, nice to meet you.
Nice to meet you as well, Manisha. Thank you. And I want to thank my fellow panelists as well for agreeing to come. I think it's a very exciting time, as you mentioned in your preamble. And so I think we have a lot of exciting stories to tell you during the next 50 minutes.
Excellent. Okay, well, with that, I know that there is a burning question that I have for both Paddy and Gaurang. So Paddy, you're here with me in our sort of virtual studio, as it were. Let's talk about how things went during the pandemic. We've heard earlier in our conversations at the conference about push and pull effects. But here we saw markets freeze up, and then we see this unprecedented and unified response from global central banks to support the normal functioning of markets. You know, this real rally round to keep things going. How did your banks navigate that period, both from an asset quality and liquidity, capital perspective?
Yeah, I remember in the very early days of 2007, and things seemed to change exponentially on a day-to-day basis. And initially there was a complete liquidity shock. And I think when the government response, the central bank's response, not just locally, but globally, I think really, they proved their worth. And I think back and I make a comparison to the 2007, 2008 global financial crisis. And I think, when you compare it to that, it always seemed as if it was reactionary, the action, whereas this time in 2020, it was very much, it was proactive. The measures, most central banks, for example, the UAE, came out with very supportive measures, both in terms of liquidity, in terms of credit quality, in terms of capital. And what that really allowed us to do was it became obvious to investors, to those in the banking system, that this was not going to be a liquidity crisis. And I think that, being able to appease those concerns meant, in fact, I was looking at our issuance statistics. I think 2020 was actually the biggest year we had for senior debt issuance. So there was a wealth of money available. On a credit, I mentioned there was credit support as well. It was really in the form of free funding. What that allowed us to do was pass on that benefit to customers, so that if customers did, retail customers had a disruption in their salaries, or corporates had a disruption in their cash flow, there was a relief there. And the idea was, look, let's give them 6 months relief. Hopefully everything will pass and business will resume, which was pretty much what happened. So what that helped with was just avoiding a sort of landslide of credit quality and banks pulling the shutters down. In terms of the capital, most banks here are very well capitalized, but we had capital relief as well. What we also learned was just to be as open with investors and as possible. I think, again, that was probably one criticism or one lesson that we had learned from the global financial crisis. So, for example, we were able to tell investors, look, we don't know if these customers are going to be able to repay in 6 months, but this is the amount of funding or amount of relief that we've given customers. This is amount has been paid back. This is the migration from stage 1 to 2 to 3, etc. And we actually gave a running commentary. What that again helped was it just gave confidence to investors that they could put an upper bound on that. In the global financial crisis, when in the absence of information, people assumed the worst. So being able to provide that information really helped. So I think if I was to write a school report, I would certainly give the central bank here, the government here, an A+. And the proactive nature was much better. And I think that actually bodes well for the banking system, that they are the guardians, if you like, of the banking system, and they proved that they were able to navigate through what was probably an even more challenging situation than the global financial crisis.
Yeah, but I think what's also indicative in your sharing there is, you joked about the greying locks, but it counts for experience, because here you had a benchmark to compare current situation to, right? And you learned so much as a result. I wonder, because he's looking pretty black up there. Did you benefit from past experience, Gaurang? How did the bank weather the storm?
I said, I think the story is not different if you go country across country, whether you take developed markets or emerging markets in UAE or Qatar, etc. I think the story theme remained more or less the same. For us, I think we were extremely lucky, I would say, or people say we had good bankers to advise, like Standard Chartered. I would say Ali was there. I think we just completed a debut Formosa deal just maybe a few days prior to the crisis. In sense, so we just started the crisis with almost issuing about $800 million worth of issuance, just settling prior to the crisis. So the initial shock that was there of the liquidity freeze was not much felt by us, because in the sense is we had the dollar liquidity through the issuances that we had done. But then immediately we had the government stepping in, providing the liquidity to take care of any domestic situations that were arising, to support the corporate sector. Through various measures, like I said, moratorium of repayments supported by government, giving us free repo lending to corresponding to the amount that we had done to the lend to the corporates, etc. While there were no formal relaxations on the credit quality, I think what most of the regulators did was to say that the lack of payment due to COVID-related issues should not be considered as a permanent deterioration in the asset quality, and then they were just kind of exempted from any normal asset quality, let's say, tests that would be there. And around 6 months down the line, I think the market scenario was very different. I think the liquidity was aflush thanks to all the central bank intervention. And again, going back to Emirates and DD experience, we followed up with another public issuance back in October. So I think 2020 was again a record issuance for us in terms of capital markets, whether it be in terms of public issuance or whether we tap certain of our existing issuances, private placements, etc. So I think it's as you rightly mentioned, the past experiences whereby it was realized that what breaks the system is the lack of liquidity. I think, and that's the timely intervention of the central banks really helped.
Thank you for that, Gaurang. Can I just apologize for some of the audio issues that we're having on the feed there? But to very briefly summarize, what I'm picking up is very much around the importance of partnerships with very, important sources of the liquidity, but also the government support, and support has been very crucial in weathering this storm. I want to take it to you now, Usman. How did investors perceive the risks? And of course, historically low interest rates. Now, obviously, we know that picture is changing.
Yeah.
But what were the implications of that?
Yeah, I think in the financial markets around that time, honestly, what was going on during the pandemic was unprecedented. Nobody had seen it before. Nobody knew how to sort of tackle it. So I think as investors in the credit market, you just went to the you just went to the lowest common denominator, which was, let's do our credit research, make sure that what we have in the portfolio, be it the bank portfolio, be it our our bond portfolio, and make sure whatever we have in there has the ability to survive. Forget looking at prices on a daily basis, they'd mean nothing. I mean, if you guys remember, around that time, you had the US Treasury, which trades in a 1/32nd market, was trading in 2 or 3 point market. This is the 10-year and the 30-year. So if the US Treasury bonds start becoming illiquid, prices are meaningless. Or looking at pricing or marking to market is absolutely a garbage in, garbage out kind of exercise. So I think sort of going back and just doing our work, saying, okay, maybe this thing lasts another 6 months, maybe this lasts another 12 months, maybe another 18 months, but that's really all you can do your math out to, right? Because after that, all chips are off. I mean, you'll have blue chip names not making it if liquidity dries up after a certain point. So it was unprecedented times. We did what we could. We in the portfolio, we didn't do any fire sales. We potentially could have. Like I talked about, bid-ask spreads are just completely blown out. You were sort of, you're throwing in the towel at that point in time. But I think the more interesting, the more interesting conversation I think to have is that we are, since probably the financial crisis in 2007, 2008, we talk about how the central banks have helped and they've stepped in, but I fear that the problem is, and you can see it with the markets right now, right? I mean, with the central bank that's slowly pulling liquidity from the market, you can see the equity indices globally. You can look at the bond indices or bond prices right now. We just don't know how to live without central bank help, right? We just don't know a world. Most investors that are practicing right now have only seen a world where the central bank's been very active and has been providing a lot of liquidity. So I fear that we just don't have the right tools going forward to navigate this upcoming storm, where it's not going to be as readily available as we'll well know because of the inflationary pressures, right?
Yep. That's a very interesting point. I think we should dig down a bit more on that just up ahead. But before we go to the next stage, I want to come back to this point actually that Paddy had made, but I'm going to address this question to you, Ali. Paddy had mentioned 2020, remarkable year for issuance, record issuance from regional banks. All of this is very important, and I'm curious to understand what sort of a role Standard Chartered played in this.
Absolutely. I think, 2020 was like a tale of two cities. So I think, as Usman mentioned, we started off on a great note. Goring mentioned the Formosa we did. In fact, he was supposed to go to Taiwan and ring the gong when the pandemic broke out. So luckily, we stopped him right in time. Otherwise, he would have gotten stuck out there. So I think we started on a great note. And then we saw markets freeze up for a couple of months, completely freeze up. And very much to your point, Usman, bid offer prices on secondary bonds became purely academic. You couldn't really trade on that. And then obviously, as Paddy Goring have mentioned, we saw an unprecedented response from central banks come in and pump liquidity. And we saw the normal functioning of markets return to markets. Eventually, fast forward till the end of the year, and we end up with the best year on record in terms of issuance for banks. In terms of volumes, regional bank issuance was up 35% from 2019, and that's despite wiping a couple of months out because of the pandemic. And I think, not only were issuance volumes up, but I think the breadth and depth of some of the deals that were done were just fantastic. A host of markets, banks were actually very nimble. They listened to advice. They accessed a host of markets, whether it's the Formosa market, whether it's the dim sum market, whether obviously the dollar market, the sukuk market, wherever we could find liquidity, banks accessed those. And I think in that time period, we saw some of the best deals we've done actually, every deal is measured by a few KPIs, whether it's oversubscription levels, whether it's geographical diversity, etc. So I think a lot of deals met all those, whether it's price tightening. So we met a lot of KPIs. So 2020 actually went down then as a record issuance. We were at the forefront of that issuance, luckily being ranked the #1 bank in the region. So I won't say too much about Standard Chartered. I'll let our issuers talk about that, about us. But yeah, we were very busy during that time period.
Yeah, I mean, thank you for all of that, because you've really helped set that background and set that context. And I think all three of you have mentioned, these interest rates being so low. But of course, that tide is one that is turning. Paddy, let's bring it to you. A frequent issuer, of course, Emirates NBD. When did you first notice that this era of historically low rates might be coming to an end? And given this turn in markets, how did you then position your balance sheet and your funding requirements for 2022? Were you still able to draw on your past experience?
Yeah. When did we first notice? I think when everybody said it's only transitory inflation. Right. But, joking aside, I think the point that was made earlier was, maybe we've overdosed on the medicine of cheap free funding, and we're now maybe looking at a consequence of this. We're partly driving the inflation that we're seeing. We have always had thankfully, we've got very supportive management who have always encouraged us to issue when we can. Again, I look at the back in 2020. I mean, I mentioned that was a record year for us. What we have been doing over the last 5-6 years is really trying to extend our maturity profile. The weighted average life of our issuance in 2020, which was close to $5.5 billion, was over 10 years. So, we did over $1 billion of private placements, of 20-year private placements. We really did try and take advantage of the appetite. And what was driving that also was, again, as Ali mentioned, just taking advantage of all pockets of liquidity. So, different currencies, we issue regularly private. Last year, we did about 8 currencies, different currencies for private placements, public issuances, and different, as I say, different maturities. Different terms. Even now, what we're seeing more of a bias for floating rate. So it's really just having that sort of flexibility to respond very quickly to where the pockets of liquidity really sit. But what we tried to do was, and again, I mentioned the supportive management that we have. We don't try and squeeze every last basis point out. We know when, that we are a big enough issuer. We typically would issue $3 billion a year. Fortunately, we have a very strong private placement engine, but we also need to issue public bonds, so that our name is in the market, our liquidity points are in the market. That complements the private placements. So we've always tried to sort of overissue, and our philosophy has been always, typically we have about $3 billion a year maturing. So we've always tried to do $4.5 billion. And what that has done is it's really over, particularly 2019, 2021, it's really built up effectively a 1-year buffer. So we've overissued for really all our funding needs for this year. So worst case scenario, if we are locked out of the market for a prolonged period of time, and again, as Ali mentioned and Usman mentioned, there was a couple of months where we were locked out of the market, where all issuers were locked out of the market as people assessed what the impact of COVID was and how long it was going to be with us. But we were, what we did was we phoned around our counterparties. We looked for alternative sources of funding, bilateral loans, etc. And again, we found out who our friends were, and particularly those first couple of months. I'm very pleased to say Standard Chartered has always been very supportive of Emirates NBD. But it was really building up that cushion, which just gives you the flexibility that when markets are agitated, that you don't become a forced issuer and you can sit and wait. This year already, although the markets have probably been more agitated or for a longer period than pre-COVID. Again, the private placement engine has been ticking over nicely. We've done over $500 million through that, and I look at the pricing on that, and people are talking about, we hear new issue premium of 30, 40 basis points. What we issued at this year in terms of margin is equivalent to as good as it's over 5 years, so it compares favorably on cost with what we issued our Sukuk at during the good times of last year.
Right.
So it's important to have these different avenues so that you can turn to those and take advantage, and also that cushion that just allows you to sit out.
It's clearly a very proactive and sort of with an inbuilt security almost type of approach. I'm curious to turn to Gaurang and ask about, and can I ask you, Gaurang, just because we had a few audio challenges, I'm going to ask you, as every media person might, to just project so that we can hear everything that you're saying nice and clearly.
Okay.
Excellent. Being an Islamic bank, was QIB more insulated in the beginning? I'm really curious about that from the market impact that's given the Islamic pool of liquidity available. Or did you start to feel the impact immediately, just like everyone else? Did any of this impact your funding and, of course, your issuance plans?
But it's being an Islamic bank, it puts us in a very interesting situation, right? We do have access to a certain specific pool of liquidity which certain conventional issuers do not have, especially in the regional investors. There are certain dedicated funds, there are certain dedicated high net worth individuals, funds, etc., who look for specific exposure to Sukuk instruments, especially the ones issued by high quality issuers. Now, Qatar, thanks to its good credit ratings, and especially, let's say, QIB, we are rated A1 by Moody's. So that puts us in a little bit more advantageous position compared to certain of our peers. But at the same point of time, we also need to be cognizant of the fact that, being an Islamic issuer comes with a certain challenges as well. There are certain investors that need to be, let's say, taken through a journey before they becoming comfortable with a Sukuk. They sometimes people do confuse the Sukuk structure with some asset-based securities, etc., and asset-backed securities. And then it's just a question of how do we bring them into the fold and try to explain to them the structure of the issuance, trying to explain to them that the underlying credit risk remains the same. There are not additional let's say, legal risks that are involved, etc. It's more about the structuring of the product that is really critical. So having said that, we do have certain access to pockets of liquidity, especially the ones which we are able to tap them on a private placement basis, etc., on the regional issuance. Even when we come out with any public issuance, we have certain, let's say, anchor investors that we normally can expect. There are certain investors we know that they look forward to when we are going to come out, because the fact is, they're not sometimes. Many of these investors, when they acquire sukuks, they tend to be holding them to the maturity. So often what happens is that people do not find enough liquid, good quality sukuks, I'm saying non-sovereign or being available in the market. So that plays positively for us. And then if we are able to time it right and able to look and trying to engage with these investors on a regular basis, we do tend to see that we tend to come out with a fairly, let's say, a decent outcome, whether it be in terms of the levels of oversubscription that we come, or whether it comes of new issue concessions that we might have to pay. Often in the sense is it is expected that, you being, let's say, we are the number 2 bank in Qatar after QNB, with being the national champion. Often people expect that not being the national champion, you are expected to pay certain new issue concessions compared to when the national champions will come out. But what happens is that while we do have to progressively pay that kind of being not being the number 1, but it's this the pool of liquidity that comes from Islamic investors that really cushions up and really able to make sure that we really do not have to give away too much in the senses, and that's where we believe it helps. But overall, in terms of if there is a generic liquidity squeeze that comes in, I think we do get impacted. So there's nothing to take away from the fact that just because if the markets are difficult, it will be difficult for us. But if we do have a comfort of certain, let's say, loyal investors, if I can say, who look forward to invest in our good quality name time and again.
Yep. Yeah, actually, you're bringing us straight back to that point that we made earlier about, partnerships, relationships, all of these things really matter in these sorts of scenarios. Gaurang, thank you for that. Usman, of course, we want to hear how investors respond to this turning tide. Were you exiting positions, sitting on cash, or just demanding?
Sorry, you mean the situation right now, or during the pandemic, or?
So we're talking about, we've got interest rates on the way up.
Yeah.
We're talking about global disruption. We're talking about a whole different game.
Yeah. No. So I think it's actually a very interesting question, because we're at a point where everybody's on the stagflation or the non-transitory train. It's beautiful. You've got the entire market on one side, and everybody's expecting inflation to be a runaway inflation. You're expecting things to crack. You're expecting, asset prices to just tank. The market's trading that way.
And you're calling this beautiful?
It's beautiful because you know what? if my mate's coming and telling me that, listen, we should be selling the market, that means I should be buying it, because that tells me that everybody's on the same side of the market. Everybody is bought into this stagflation narrative, and the markets have started to price this in, or if not already fully priced this in. Right? So, because I'm definitely not the smartest guy in the room, but I know there's stagflation, or there's a lot of inflation out there. So chances are my counterparts have already priced this in. So we're at a point where asset prices are starting to look interesting rather than selling. We are on the side of buying. The problem is that in the last couple of 3 sell-offs, the catalyst has been the central banks, right? That's what has sort of started the short covering rallies in the markets. Those are the guys who've come in and sort of put their balance sheet behind it, and everybody's jumped onto the bandwagon. They're not there anymore. These risks that we talk about are quite priced into the market. We just don't know what that catalyst is going to be. So that's what we're doing. So we're, rather than selling right now, like I said, everybody is on the same side. We would like to take the contrarian view to that.
Okay, well, thank you for explaining what you meant by that, because it felt like a counter narrative for a second. But I think what it harkens to is some of the conversations that we had in earlier panels. And by the way, the content does get made available. So if you missed anything from earlier, you can go back and listen to it. And this was this idea that actually amid the turmoil, there is opportunity. And it was around valuations in particular being at a level where you want to play the long game. Would you agree with that?
Absolutely. So I think for example, the guys who bought during the pandemic, during the depth of the pandemic in late March, and that was when you had the least amount of visibility, right? I mean, honestly, if you guys go back at that point in time, the world was going to come to an end, right? I mean, that was it. Yet people bought, and those guys benefited the most. So yeah, I mean, I think we need to, the narrative hasn't gotten to a point where the world's going to end yet. We're waiting for that. So it's probably the bottom of the market, right?
Well, let's charge on towards net zero, shall we? And let's not have to talk about an existential crisis of any kind. Ali, let's take it to you. When did you realize that market conditions for issuance were not as robust as they'd been during the pandemic? And how did that impact regional issuers and their issuance plans?
So I mean, this was definitely after the FOMC in September 2021. I mean, it was very clear. Markets were like super constructive, and then suddenly they just fell off a cliff. And, I think the Fed talked about easing out the quantitative easing, moderating the asset purchases in that particular FOMC. Markets got a bit spooked. Issuers, I think you've heard from Paddy and Gaurang, a lot of them had sort of pre-issued, so issuers sort of stepped back, waited for more constructive conditions, and instead of getting more constructive conditions, we just went into sort of a downward spiral. And look, to be honest, I don't blame either issuers or investors, when in a period where rates were rising, but it wasn't even a sort of a one-way trajectory up. You saw the US Treasury rates literally bouncing around like a yo-yo, going up, but going up and down like a yo-yo. And it becomes very difficult for someone to go and sort of raise funding either from an issuer side. They might end up paying a lot more with a day's difference, or from an investor perspective where they buy into a bond or a sukuk, and the next day you see the price tank. So obviously conditions started to worsen around that time, Q4 of 2021. And then we thought, obviously with year end approaching, a lot of investors having made good money during the years, the issuers having pre-funded for 2022, we would probably take a bit of a pause. Everyone would have a nice Christmas break, come back refreshed, and markets would look afresh. But sadly, markets have continued in that direction, and it's been very challenging for all EM issuers. And we have issuers here. Gaurang talked about it. Paddy talked about it. New issue concessions. It was a term that these guys had taken out of their vocabulary. So when you have bankers like me going and telling them you have to pay 20 basis points new issue concession, it's something they've never heard before, right? So it was a complete different sort of a scenario, and that's what brings us to today.
Yeah. So you bring us to today, and now I really want us to throw forwards as the remainder of the conversation. We've actually got questions. If you want to get your questions on this board, please make sure that you send them in, because we don't have too much time left. And that is an appeal, not just to the people in the room, but also to our audience watching all over the world. So I'm going to put this question to you, Paddy. And forgive me, because I'm not totally aware of the context, but I'm going to share the question anyway, and perhaps you can provide some of the context. And gents, if any of you also want to pick up on the answer, please do signal to me if that's something you'd like to do. So the question is this, and this is referring to the UAE local currency bond market. The local currency market has now commenced with the first T-bills issued. Yep. Is this correct? Yes. I see nodding heads. Excellent. Do local Dubai banks see this as a viable new funding market going forward? And what about non-bank investor participation in local currency bonds issued by banks or corporations in the UAE? Now, that's a good question.
Yeah. So, sorry, can you just repeat the second part to that question?
Well, you remember the first part.
Yes,
how about we deal with the first part,
certainly,
and then we'll come back to the second.
Yeah. No, for us, the development of the local currency market is hugely important. It's a step forward. You know, for us, we see it as another avenue of funding. I talked about the range of currencies that we issue in, the range of maturities. So, you know, fixed floating, having another currency is very important. I actually think back to 2009, 2010, I think it was, where the biggest currency that we issued in was dirhams. And since and the message there was that for a local bank, which Emirates MBD was very much then, I would describe it more as a regional bank now, but when it was more of a local bank, what we found was that the people who were happy to buy the credit, and remember the challenges that Dubai had in 2009, 2010, that's why dirham was 60% of our total issuance, because local investors were familiar with the name, they understood the concept of support, etc., probably more than international investors did at the time. So seeing the dirham currency, the local market issuance coming in can only be good for ourselves, and I would say that the same applies for all issuers, be it banks, be it corporates. So it's something that we're very, very pleased to see.
Yeah, just to add to that, I think it's actually a fantastic development. So UAE is new to the local currency market, but if you look at the other countries in the region, you've got Saudi, who's got a well-established local Saudi Riyal curve. You've got a local curve within Oman, and you know, it's very interesting, even for investors, even for investors outside the region who are very seriously looking at these local markets, because it is a de-risking exercise for us, not because the credit is different, but because the vol statistics are different. So how the dollar market behaves in stressful time versus how the local market behaves at certain points in time, actually it helps to reduce the overall volatility of our portfolio. So we liked adding local currency paper, and especially pegged ones that don't act the same way. And the second thing is that, and the reason, the one is the vol characteristics, and the second thing is there's always a premium to be had for us over the dollar market. So we get, kind of that's what we're seeing up to now, but I'm sure these guys are going to get together and take that away from us. But the premiums are, the premiums are there. We're getting paid a little bit more to be in the local markets versus the
and perhaps, Usman, if I may, can I ask you also the second part of this question, and then I'll come back to you, Paddy, and maybe you can give your views. So the second part of this question was, what about non-bank investor participation in local currency bonds issued by banks and corporations in UAE? Perhaps we can extend on that a little bit.
Yeah, no, I think that's the same thing. I think there's a lot, like I said, I think the international, so you gotta, so I think if you take a step back, the GCC is not a block anymore, right? I think if we go back about 3 or 4 years ago, if you look at it from an international community standpoint, they did not make a differentiation between, let's say, Saudi or the UAE or Qatar. They were just one big basket. It was maybe an oil basket, and it didn't really matter which one you invested in, and you really didn't even have to invest in, honestly, because it was an off-benchmark exercise. But the issue is, in the last couple of years, and we've spoken about this in the past, is that sort of the GCC has come into the fold. It's part of a global index, a very widely followed index on the debt side. People are starting to learn more about the region. I think they're understanding the intricacies. They're trying to understand the geopolitics. And so there's a lot more interest in not only the hard currency, but as an extension, the local currencies as well, or the local currency market as well now. We're seeing a lot of interest within, like I said, like the local currency market in Saudi Arabia. They're facilitating sort of. It's still a little bit tricky to get in there, but I think I think that'll be solved for pretty soon. But yeah, so I think there's going to be interest, not just regional asset managers, but global asset managers are going to use this market and invest. So I think there's definite interest there.
Okay, and Paddy, just a brief reflection on that second question.
Yeah, it goes back to Usman's point that, if you go back 5 or 10 years, a lot of investors just looked at GCC pretty much as, one block. And now you have much greater differentiation. And the ability, therefore, to have dirham currency versus Saudi riyal, et cetera, just makes that again an easier differentiator for investors. When they're building their portfolio, or when they want to take a particular view on, for example, the UAE versus one of the other GCC countries.
Thank you very much.
Manisha, maybe if I could just add one point on that. Yes, very briefly. So the non-banks are very important, I think, in the local currency market. And if we look at Saudi, for example, they have a vast participation from the non-banks into the Saudi Riyal local currency market. And that has enabled a lot of the Saudi banks to actually go and raise capital in Saudi Riyals. So, banks cannot buy other banks' capital because it's the capital, sort of there's a deduction on 100% deduction on capital.
Yeah.
So you typically go to the non-banks for that. And I think that's very important for that tier to develop. So for the whole suite of products, not only on the liquidity side, but the capital side to also develop in the dirham market.
And actually, I think that what you're talking about could be instrumental in the subject that I now want to pivot to. We have less than 10 minutes left, so I really want to get this in. And hopefully, Gaurang, if we can hear you, this is around the first green bond that was issued in 2017, while the first sustainability sukuk wasn't until actually February of this year. Do you expect ESG to be a key theme moving ahead for regional financial issuers? And how do you view this from an Islamic banking perspective?
I think ESG is now becoming an increasingly important aspect of both in terms for the issuers as well as the investors, right? As we see more and more countries and more investors putting pledge towards the net zero kind of targets they're putting across different years by which they will achieve, you see more and more engagement by the investors where they are now trying to look into what are the ESG commitments of the organization. I think it started with, as you said, 2017 green bond issuance, whereby initially majority of the issuance were more towards, as they say, use of proceeds related issuance, which is the green bond. However, more and more, I think the importance and the, let's say, the gamut of ESG has become widened, and now more and more more and more investors would like to see and that how the issuers are really making meaningful integration of these ESG initiatives in their business models, in their lending policies, etc., and trying to not make it whether you are an ESG exclusion or whether it's an ESG related issuance, but more looking towards the transition to say it's and that's where the ESG, which is more like sustainability linked issuances that are more and more becoming prominent. I would say not only from the sukuk format perspective, I think it is also overall, if you see the trend that are emerging with what the forecast is, that for this year, almost about 25% of the entire ESG issuances would be sustainability linked issuances rather than purely user proceeds. So I think what is happening is that the organizations are more and more investing into maintaining the ESG data because I think no longer are the investors saying that does it meet the ESG principles, or does it meet have you obtained the second party opinions? But they really want to see a progression. They want to see in terms of the real data. They want to see you commit to certain directions, and they want you to see that how you are closely following them. You see more and more as the investors are trying to put net zero initiative, or net zero targets into their portfolio, into their investment objectives. It is slowly trickling down into their specific portfolios. While the dedicated ESG portfolios are maybe still small, but it's just the normal, regular, conventional investors are making investors really go and see that how committed are you towards the ESG goals. You will see more and more investor engagement happening between by the issuers with the investors. I can tell you that the big difference you can see is that every time now an investment banker like Ali comes in, there is a full-fledged ESG expert embedded in their DCA
Right.
panels to make sure that keep reminding issuers to like us to say, hey guys, do not forget, it's not only about raising capital, but it's trying to raise let's say responsible capital, if I can say, as you keep moving forward. I think, but there's still a lot more work to be done. I think there is more and more regulation that are required to bring in more standardization in terms of what are the criterias, etc. And I think my take is, I think what will be interesting to see is how does this entire shift towards ESG, not only in terms of investing or issuance, etc., but overall global commitment to ESG has an impact on basically the macroeconomic. How does it impact on the GDP?
Yeah.
How does it impact the inflation? I think and the role of the central bank is really going to evolve. You now see the central banks across the different geographies coming out with the climate risk policies and trying to make you more engaged and committed to it. So I think that's where I think a very responsible. I think bankers are not known to be very, let's say, very favorable in terms of on this common street. But I think where the bankers have started adopting this ESG and other commitment to social, I think it's changing. And whether you will be a conventional issuer or whether you are a sukuk issuer, I think it will be safe. On the contrary, for the sukuk issuers, the responsibilities are much more, let's say, stricter, because we anyway are supposed to be doing a much more, let's say, socially responsible banking, being compliant to Sharia principles. So I think ESG is more a natural extension or a progression for an Islamic bank when you come to sukuks, etc.
Makes absolute sense. Thank you very much for that, Gaurang. Our time is ticking, gents, I'm afraid. I had questions around digitalization and a lot of sort of revolutionary aspects of the banking sector. But sadly, I have to say that those will be left for another day. I know that you are all contactable. I'm sure that you are networked on social media. So to those of you who want to hear more about those subjects, can I invite people to get in touch with you and explore some of these subjects?
Always happy to talk.
Excellent. Well, look, it just remains for me to thank you all once again for joining us on this panel. And Ali, thank you so much for convening all of this brain power and insight and great conversation for us today. So Ali there at the end, we have Patrick here, Usman, and down the line from Doha, we have Gaurang. Thank you all.
Thank you.
A round of applause for our guests.
Thank you.
So,